I know that I'm always going to come out on top, right? I believe that 100%. But I'm scared for the world. I'm scared for the United States in particular. I'm scared for what this is going to mean if it gets beyond about 3 weeks, as I'm going to explain to everybody. So for me, who is bullish on the world, who is constantly telling everybody go out there and do it, who says there's opportunities everywhere, because for the entirety of my life, no matter how ugly it got, there have been opportunities everywhere. That will all go away if this goes on longer than 3 weeks, maybe a month. Now, ultimately, those opportunities will come back without a doubt. But the hole that we will have to dig ourselves out of is not one that you just turn back on. There is a belief by lots of scared people that it's going to be okay. We just have to get through a couple of weeks, and then, boom, it's right back where it was. And that's just 100% not true. There is a small window, and we're going to run out of days here very soon, that still will hold true to an extent, that it can still be managed through. That if you have, you don't have income for a week, you can't pay your vendors will understand, because they just lived through what they've had to live through, and the wholesaler is talking to the factories, and they're getting terms on what they're wholesaling because it just sat in their warehouse. Everybody, it has that trickle effect, and everybody will want to come together and work together to make it work, right? To make it equitable for everybody. And on a one-to-one basis, business to business, we can do that. I can call up my gas provider and negotiate with my gas provider and say, hey, dude, you saw what happened. You usually pull the money now. I need you to hold that for 2 weeks so I can get on the other side of this. I can do that. If I'm a bar, you're delivering me beer. Hey, man, I need that beer to sell today to pay my bills. Going back a week, it's going to take me a little bit while to be able to pay that one bill. Can we float that for 2 weeks, 3 weeks, 2 months, 3 months? And you're going to be able to get away with that. Right? All of the conversations and all of the negotiations between one-to-one, that is me to you, you've provided me something, you and I'll negotiate that out. So if you're the supplier, you've got to deal with your factory, because you're going to be sitting on a ton of inventory because the retailer isn't buying it from you. But the retailer owes you money for what he did buy from you up until the doors close. Now, when the doors open, the retailer still has that same product to sell. So it's not like he's running out to buy new product.
Yeah.
Okay, so the wholesaler is going to be sitting on it and not ordering more from the factory. The factory is going to be sitting on a ton of product that's not moving. So there's just going to be this huge logjam as soon as the process does open up. And if the people on the retail end, the customers, don't have the money to go suck up that excess, right, that whole system's going to stay backed up for a while. So there's going to be as a group in that line, if you use that example, they are going to have to work together. They are going to have to self-sacrifice across the board in order to get that retailer selling to that consumer. But that's not just something you turn back on, right? All of those sales are gone. In fact, not only are all those sales gone during the time that it was closed, but the consumer, the customer's not out earning money, and the government sending us $1,000 or $2,000 ain't going to do shit. That's not going to matter at all. That's a drop in the bucket. In fact, I don't think they should be doing it. They should be sending it to all of the businesses, but we'll get to that. So that's the way that works, and that's not going to just be able to turn back on and overnight is going to last for months and months. And so I understand, though, the fear that everyone has, and I don't necessarily disagree with that. There is going to be a tremendous amount of opportunity on the other side of it, but the other side of it may be 2 years away the longer it goes. And here's why. We are going to have there's nothing they can do to stave off total catastrophic failure in the economic system once the bond market crashes. Here's how this works. Right now, the government, the Fed, is buying everything. So a corporate bond is, what's the company that is Disney?
Okay.
So Disney just floated $600 million in bonds, and these are how these big companies finance themselves. And so they'll use bond issuance, which they'll guarantee 2.5% interest, and then institutional investors, retirements, right? California, I mean, these guys are sitting on billions and billions of dollars, college endowments, things of that nature, insurance companies, they're all looking for yield. And so they come in and they'll buy these things at these low interest rates, but it essentially gives their money a place for their money to sit with a return that's reasonable. It's a safe bet.
A consistent growth.
It's able to hold consistently and not lose anything at or above the rate of inflation, as an example.
Mm-hmm.
So the ones I believe that Disney just floated are 3.5%. Okay, that's a little bit more than typically they might have to, but in order to bring in buyers, they need to entice buyers. And the longer this goes, the higher that interest rate that they're going to have to pay will have to be. The higher that interest rate that they'll have to pay will have to be, the more it impacts their business negatively. And ultimately, if this lasts longer than 2 or 3 weeks and we have catastrophic failure, there's no one to buy them. Right now, the federal government is buying them up. Now, they started too late. Literally, it's like today. They just started. Today's Monday. What's the date today? 22nd or something?
23rd.
23rd. They've just started to buy, and they're buying them in mass. So what they're doing is they're buying all of the corporate bonds so that we don't have a complete meltdown of the system over the corporate bonds. That's one. Make sense?
Yeah.
The much bigger number and the bigger problem that they've not dealt with, and this is why arguing over government-sponsored abortions and airplane miles per gallon, is because come about the 5th, when everybody's mortgages are due, 73% of those mortgages are sold to bond markets. That is, they'll take 100, 200, 1,000 of these mortgages. They compile them together, just like I just talked about corporate bonds. Mm-hmm. You have these industrial property bonds that are compiled together and sold to investors. And the investor, for the same way, is looking at them and going, okay, I'm going to make good, steady 2.5%. They're rated. So you have AAA, AA, or AAA, AAB, AAC. They have, if you've read the newspapers, you'll hear these terms kind of bandied about, and it is the risk nature of the bond. Many investment companies and insurance companies are precluded from buying anything but AAA rated bonds, and that is the best companies making their payments. And so the less likely people are to make their payments, the higher the interest rate the person is paying on their mortgage, the higher the return the investor is going to get on that mortgage. More risk, more return. What happens when nobody makes their, I won't even say nobody. What happens when 25% of the people don't make their first mortgage payment? The mortgage payment doesn't get made to the processor. So there's a servicer in between. Let's say that you used Quicken Loans, okay, to get even your real estate, your home mortgage. This applies home mortgage, and I'm speaking specifically about commercial or industrial. If the payment doesn't get made on the 5th, then the servicer is going to get a hold of you. Quicken Loans does your loan, just as an example. They do residential mostly, but as an example, they take that loan, and that loan is bundled, and then it's sold to investors on Wall Street. And about 70% of those are sold to investors. So Quicken's going to bundle those all together and sell them to investors. Now, they keep a little bit for themselves for originating the loan and selling the loan off, and then they keep a little bit for themselves on an ongoing basis so that they can service the loan. So they're loan servicers. And so Quicken Loans, you send your bill to Quicken, but Quicken doesn't own that loan. It's been sold to Wall Street. They're just servicing the loan. Okay? What happens when Quicken Loans doesn't receive, let's say, 25%? And I don't know what the exact number is that would tip it over, but it's not 100. I'm not saying because Jerry, some people will pay. Yeah, but there's a number, and it ain't very high. 20%, 15% that don't pay. I mean, it's not going to be very high.
That's a lot of money.
Correct. And so let's say it's 25% for purposes of this conversation. We are talking trillions of dollars. We are talking gigantic amounts of dollars. And so it's not trillions paid. I should say we're talking about trillions of dollars worth of real estate. We're talking about billions and billions of dollars, hundreds of billions of dollars in payments. Come the 5th.
Yep.
Right? Over the course of a year, I think monthly payments are something like $2 trillion. Maybe that's yearly payments are $2 trillion. We're talking about a big set of numbers. So again, I don't want to pretend like I know every number.
Yeah.
So the bond market caves in. All of a sudden, there's no yield being paid out. There's no cash going into these investors. And so then all of their numbers are thrown out of whack. And many of them have bylaws that say that they have to have a certain number of good loans on the books, right, or good investments on the books. And once those investments go south, then they have to be taken off the books. And then they have capital requirements that the government pushes on them. This is both for banks and particularly when you are managing other people's money, that you have to have certain capital requirements. Well, now you got to go raise money, right? If the loan comes out of the mix and you can no longer use it, you have to replace that equity somehow, or the books continue to be upside down. I'm trying to
dumb it down,
make this as simple as I can. Yeah, and I'm probably making it harder on myself than I otherwise would. But essentially, combine that with what they have, something called a mark-to-market accounting. And so if my building, so now you have this investment, and it was AAA rated, but the company that was paying, or the 100 companies that was paying it, 70 of them, doors are shut. And they've been shut for 3 weeks and they have no money to make their rent payment because, again, how do they live?
Check to check.
Pay tomorrow what they earned yesterday, or pay yesterday what they earned tomorrow. But the system works like this, and it has always worked like this. And we've grown the system to where it is because it works like this. And only a catastrophic event like this is something that would derail that. 2008 was very different. 2008 was a true economic event. This is somebody got sick, and the government shuts it all down. It's at that point that you can't put it back together again easily. It's at that point that you have such catastrophic failure. No one will invest in the United States because you don't know whether or not that investment's going to hold up. Or you're going to be talking about, right now we pay 2% on our $22 odd trillion that we owe. Now we're going to owe $26.7 odd trillion. The interest rate on $27 trillion, every one interest point, right, is a shit ton of money.
Mm-hmm.
And so then all of a sudden, the whole world order gets rejiggered. Everybody looks at it differently and says they're going to start questioning the dollar. They're going to start questioning the strength and the might of the United States, both militarily as well as economically. How can anybody survive this? The bond market's failing is Armageddon. That's the catastrophe that we have to get in front of if we hope to stave this off.